Good day, team. I just received a call from the CEO of Kang Company, a manufacturer of ballet shoes. So they've reached out to request our assistance in handling several business transactions related to their ongoing expansion. So the situation here is that Kang Company is currently experiencing rapid growth and is scaling up its production operations to meet increasing market demand. And as part of these expansions, they've recently completed several acquisitions of property, plant, and equipment through different transaction types, including deferred payment arrangements, lump sum purchases, and also non-monetary exchanges. And as their newly appointed fixed asset accountant, we have been assigned to handle the accounting for these transactions. And our role will be to ensure that these acquisitions are recognized, measured, and classified accurately in compliance with the relevant financial reporting standards.
I've reviewed Ms. Kang case, and the issue here is the proper valuation and classification of assets acquired through three distinct transactions. First, equipment acquired through deferred payment using a zero interest bearing note must be recorded at its present value and not the face value of the note, and should have include any directly attributable costs such as freight and installation. Second, in the lump sum purchase of inventory, land, and building must be allocated based on the relative fair values of each assets. Proper classification is critical here, as inventory is a current asset while the land and building are considered planned assets, and misallocation can impact depreciation in financial reporting. Third, in exchange of used trucks and cash for land, because the exchange is a commercial substance, the land should be recorded at the fair value of the consideration given. Any difference between the truck's book value and fair value results in a recognized gain. Additionally, Kang must accurately distinguish plant assets, which are long term assets used in operations, and other asset types such as speculative buildings, prepaid insurance, and exclusive process rights, ensuring the compliance with accounting standards and reliability of the financial statements.
But first, let us take a moment to understand the characteristics of plant asset in order to apply the correct accounting treatment. Land, building, and equipment are major components of plant asset that possess key characteristics distinguishing them from other asset types. These assets are tangible, meaning they have physical form and substance, and they are long-term in nature as they are expected to provide economic benefits over multiple accounting periods. Land is unique among these because it is not subject to depreciation. It has an indefinite useful life and does not lose value through usage or time in the same way as other assets do. It is recorded as in historical costs, which may include legal fees, title costs, site preparation expenses, and other related expenses. Buildings, in contrast, have a limited useful life and are depreciated over time to allocate their costs systematically as they are used. Their costs include not only purchase price but also renovation costs and other expenses incurred to prepare the building for operational use. Equipment shares many of the same traits as building. It is depreciable and used in operations, but it often has a shorter useful life and may require maintenance, repairs, or upgrades during its lifespan. All three are classified as non-current asset on the balance sheet and are recorded initially at cost. They are not easily convertible into cash and play a vital role in the long-term productive capacity of the business.
Thank you for that input. I think we're all set now to start going through the transactions.
For the first transaction, on June 1, 2025, Kang Company purchased equipment from Wyandotte Corporation. Payment was agreed to be made over 4 years in equal annual installments, totaling 280,000 pesos. Importantly, no interest was stated, but a 10% market rate is applied. Freight and installation costs were also incurred in the amounts 4,250 pesos and 5,000 pesos, respectively. So the key phrase here is that payment is due at the end of each of the next 4 years. Since the transaction date is on June 1, 2025, this means that the first payment is due 1 year later, which is on June 1, 2026, and this continues annually for the next 4 years. So one might ask, why use the present value of an ordinary annuity? So in this transaction, the timing of the payments matches the definition of an ordinary annuity, wherein payments are made at the end of each period. The use of the present value factor 3.17 confirms this. It assumes four annual payments, which is 280,000 divided by 4, we have 70,000 pesos, each made at the end of a full year. Next, let's compute the present value. So as mentioned earlier, we divide the total obligation of 280,000 by 4 to get the annual installment of 70,000 pesos. Then we multiply it with the present value factor of 3.17, resulting in a present value of 221,900 pesos. Next, under the accounting standard PAS 16, all costs necessary to bring the asset to its intended use must be capitalized, or in short, we should add all directly attributable costs to the asset. So we add the freight cost, the installation cost, to the present value of the note. So we have 221,900 pesos plus 4,250 pesos and 5,000 pesos to bring a total capitalized cost of 231,150 pesos. In summary, the first payment is made 1 year after the transaction, matching the ordinary annuity assumption. So the subsequent payments are as follows. It is made on June 1, 2026, June 1, 2027, June 1, 2028, and lastly on June 1, 2029. We then use the appropriate present value factor at a 10% market rate. So the total cost to capitalize on the books or the equipment's acquisition cost as of June 1, 2025 is 231,150 pesos.
Thank you so much, Krisha. Does anyone have any additional insights, questions, or require any clarifications? I guess we have none. With that, I would like to move forward with the second transaction. The second transaction of Kang Company revealed that on December 1, 2025, Kang Company purchased several assets of Yakima Shoes Incorporated, a small shoe manufacturer whose owner was retiring. The purchase amounted to 2.2 million and included the assets listed on the slide. Kang also engaged the services of Tennyson Appraisal Incorporated, an independent appraiser, to determine the value of the assets. So, as we can see, the value of the assets in the book of Yakima is different from its fair value. The inventory, land, and building have a book value of 600,000, 400,000, and 700,000, while the fair values are 500,000, 800,000, and 1.2 million respectively. Kang also incurred 80,000 of interest expense in financing this asset. So in this kind of transaction, the first thing we should do is to determine the proper basis for asset recognition. Since the book value and the fair value of the asset aren't equal, we need to allocate the purchase price based on its fair value because according to PFRS 3 business combinations and PAS 16 property, plant, and equipment, when assets are acquired in a lump sum transaction, the purchase price must be allocated based on the relative fair values of the identifiable assets. The rationale behind this is that the book values from the seller Yakima are not relevant to the buyer Kang for recognition purposes, so Kang must use the asset's fair values to determine the cost of each asset acquired, then allocate the total cost accordingly. Now, the first step in allocating the purchase price is to compute the total fair value of the assets. Since the inventory, land, and building have a fair value of 500,000, 800,000, and 1.2 million respectively, we can get a total amount of 2.5 million. We can now then allocate the total purchase price using the relative fair value method. Using the fair value method, we can compute the proportions of each asset by dividing its individual fair values over the total amount of fair value, which is the 2.5 million, to get the assets proportion in percentage. So as we can see, by dividing each individual fair value to the total fair value, the inventory has 20%, the land has 32%, and building has 48% of the total fair value.
After getting their proportion in the percentage, we can allocate the total purchase price by multiplying it by the percentage to get the value to be recognized by the Kang Company. So based on the allocation, the inventory will have the value of 440,000, the land will be 704,000, and the building will have the 1,056,000, which equals the purchase price of 2,200,000. Now, how about the 80,000 interest expense incurred by Kang Company in financing these assets? So according to the Philippine Accounting Standards number 23, borrowing costs, interest costs may be capitalized only when incurred in connection with the construction or production of a qualifying asset. Qualifying assets are those that take a substantial period of time to get ready for use, for example, buildings under construction. In this case, the inventory, land, and building were ready for use upon acquisition. Therefore, the 80,000 interest expense must be expensed in the period incurred.
Moving forward, I will now proceed with the next transaction. Under PAS 16, land is not subject to depreciation. This is because it is generally considered to have an indefinite useful life. Unlike buildings, machinery, or vehicles, land does not suffer from physical wear and tear, nor does it have a finite economic life that can be systematically allocated over time. As such, it is excluded from the depreciation schedules entirely, which directly affects how we calculate and recognize periodic expense in profit or loss. Land often has the potential to appreciate in value over time, particularly when located in areas with increasing economic activity. This is in contrast to most other PPE assets, which typically decline in value due to usage, obsolescence, or physical deterioration. While land is initially measured at cost, PAS 16 permits the use of a revaluation model after initial recognition, provided that fair value can be reliably measured on a continuing basis. That said, unless the revaluation model is adopted, any increase in fair value remains unrecognized under the cost model. Under PAS 16, when an item of PPE is acquired through a non monetary exchange that has commercial substance, it should be measured at fair value of the asset given up. In our case, both conditions for fair value measurement are met. The exchange has commercial substance because the land will be used for parking lot adjacent to the plant site, which is expected to generate future economic benefits different from those of the trucks that were disposed of. The fair value of the trucks given up has been reliably measured at 460,000 pesos based on external market data, and this is supported by our purchasing agent's market assessment. In addition, Kang Company paid 190,000 pesos in cash as part of the consideration. Therefore, the total consideration transferred for the land is the fair value of the trucks, 460,000 pesos, plus the cash payment of 190 pesos, amounting to 650,000 pesos. That amount becomes the initial cost basis of the land in our books under the cost model of PAS 16. We do not use the truck's book value of 350,000 pesos because book value reflects historical cost less depreciation and does not represent the fair value of the consideration given. Unless there are any objections or further questions on transaction 3, I think we can now proceed to the next transaction, Ms. Alexa.
Now that we've covered the first three transactions, we're all set to move forward. Now, let's take a look at the additional transactions for the fiscal year ended May 31, 2026.
The first transaction is a building acquired for speculative purposes, which refers to a property purchased with the intention of generating income through resale at a profit or through appreciation in value rather than for company's operations. Because the intent behind the acquisition is investment rather than for operational use, the building should not be classified as a plant asset. According to PAS 16, property, plant, or equipment, plant asset or PPE are tangible assets that are held for use in the production or supply of goods or services, for rental to others, or for administrative purposes, and are expected to be used for more than one period. Since the building acquired by Kang Company is not intended for operational use but rather for potential gain through resale or value appreciation, it does not meet the criteria of PPE. Instead, under PAS 40 investment property, such buildings should be classified as investment property, which defines as property, such as land or building, held to earn rentals or for capital appreciation or both, but rather than for use in the production or supply of goods or services for administrative purposes. Therefore, the appropriate classification for the building is investment property and not plant asset.
The accounting classification of a 2-year insurance policy covering plant equipment, it emphasizes that this type of insurance is not considered a plant asset because it is not a tangible item used in the production process. Instead, it is categorized as a prepaid expense since the payment is made in advance for insurance coverage. It will benefit the business over a future period. As a prepaid expense, it is initially recorded as an asset on the balance sheet and then gradually expensed over the 2-year duration of the policy.
Moving forward, the third and last additional information given by Kang Company is the purchase of the rights for the exclusive use of a process used in the manufacture of ballet shoes. This is the acquisition of an intangible asset, specifically intellectual property. By purchasing exclusive rights to use a manufacturing process, the business gains a long term competitive advantage, often improving efficiency, quality, or cost saving in production. The exclusive rights to a process are intangible assets, meaning they lack physical substance but provide future economic benefits. This transaction correlates with three accounting principles, which are the cost principle, the matching principle, and the conservatism principle, where the right should be recorded at its purchase cost, including any legal or registration fees. It should also be amortized over the useful life of the right, matching expense with the period of benefit. And in case of impairment, the asset should be written down to its recoverable value.
The case of Kang Company provides a comprehensive overview of the accounting treatment for property, plant, and equipment acquired through various means, including deferred payment plans, lump sum acquisitions, and non-monetary exchanges. Through the analysis of the three transactions, it becomes evident that accurate asset valuation is essential for proper financial reporting. Present value, fair value, and the book value must also be properly applied and identified. The first transaction, we learned that when payments are deferred, the assets should be recorded at its present value, recognizing the time value of money. The second transaction showed how lump sum purchases must be fairly allocated to each asset based on their individual fair values. And lastly, the third transaction emphasized the role of fair value in exchanges with commercial substance, where the asset received is measured using the fair value of the consideration given. The key insights from this case are: first, we must properly understand how and when to recognize an asset. Second is to correctly determine what classification it falls under. And lastly is to apply the appropriate accounting standards such as the historical cost, fair value, or present value depending on the situation, because this is crucial not just for accurate financial reporting but also for making informed business decisions and ensuring compliance with the accounting regulations. To wrap everything up, that's all for our discussion today. Thank you everyone for your cooperation and valuable inputs. Hopefully, our analysis will be helpful to Kang Company in supporting their business decisions.